Righto, accounting folks, welcome back to our second lesson. This is topic 2. This time we're going to be talking about this little thing called the accounting equation, which is a really important aspect of accounting and something that you will need to understand and know a little bit about. So let's get straight into it. This one shouldn't take too long. Okay, the accounting equation it's a relationship that exists between the assets that a business holds, the liabilities that it has, so the people it owes money to, and the owner's equity. And we learnt from the previous lesson that owner's equity is really just a special type of liability that separates out the money that the business owes back to the owner. And we know that that's all a result, that whole concept of owner's equity all results from this thing we learned about before called the accounting entity assumption, where we focus on the business as an entity which is separate from the owner, and our role as an accountant is to worry about the business, not as the owner. So we separate that owner out by having this thing called owner's equity. So we have this accounting equation which explores that relationship between assets that the business holds, the liabilities that it has, and the owner's equity, the money that the business effectively owes back to the owner. And that relationship must always be in balance. It is always an equality. And what that means is that the usual expression of the accounting equation is that assets, so all of the assets, and we know from last lesson that assets are items of value that the business owns, all of their assets totaled together, combined together, add their value together, equals the total value of all of our liabilities plus the value of the owner's equity in the business. So liabilities plus owner's equity combined will always equal total assets, always. If it doesn't, if we've got an accounting equation that is not in balance, there has been an error made in the recording, in the accounting record somewhere. Has to have been an error made. This equation must always be in balance. And just like equations in maths, we can rearrange that equation and express it in other forms. And there's a separate video going through the basic maths of rearranging the equation, but you don't necessarily need to really understand that. It's useful if you do, but you don't need to. You can pretty easily just learn and memorize the 3 forms of the accounting equation. A equals L plus OE. If we rearrange it to get owner's equity by itself, well, if we just want to calculate owner's equity, well, that's equal to assets subtract liabilities minus liabilities. And if we just want to isolate liabilities and get them by themselves and work out liabilities, then we can do that with assets minus owner's equity. That will give us liabilities. Okay, so just a quick note here that we're starting to use some abbreviations here. A for assets, L for liabilities, and OE for owner's equity. So if we move along and have a look at a couple of examples. So if we've got this person, B. Jones, and they start a business. And they start that business by putting in $20,000 of their own money, $20,000 cash. So it's their own money that they've got from somewhere. We don't really care because we're concerned with the business. We're concerned with worrying about what the business is doing, and the business is just getting $20,000. So that's going to be eventually owed back to B. Jones. So that's an owner's equity from what we know about owner's equity. B. Jones is also investing in this motor vehicle. It's worth $10,000. So it might be a delivery vehicle or something. So if we wanted to work out what the accounting equation was then, well, we need to decide what's changed. Have our assets changed? Well, yeah, from the business point of view, they have. Because the business has this $20,000 cash to play with. That's an asset. That's an item of value to us. It's in money form already, but it's certainly an asset to us. So it gets listed as an asset of the business. So does this motor vehicle. We own that. Business owns it. It has value. We could sell it, get money for it. So we list that as an asset. So our total assets, in turn, when we're looking at the accounting equation, are our $20,000 cash plus this $10,000 motor vehicle. They are our assets. Do we have any liabilities? Well, no. We don't owe anything to anybody at this point. However, we do have this $30,000 of owner's equity. Why? Well, because both of these two things here, the assets that we have, how did we get them? they were invested by the owner. So that means the business owes that much back to the owner, and we record that in owner's equity. So if we look at our equation, we've got total assets of $30,000, and that equals, well, we've got no liabilities, but we've got $30,000 of owner's equity. So both the left and the right hand sides of our accounting equation are in balance, which is what we want. If something else happens now, there's another transaction, another financial event. B. Jones, the owner, goes and takes, on behalf of the business goes and takes out a loan for $20,000. So they need more cash. So he goes and gets a bank loan for $20,000. How does that change the accounting equation? Well, what does that $20,000 mean? Who did it come from? It came from the bank. Are they just going to give it to us because they're good guys? Don't think so. That's a loan. We have to pay it back. It means we owe money to the bank. Which type of account does that fit into? Liabilities, yeah, because it's money we owe back to the bank. So that $20,000 loan we got fits right there as a liability. But what do we do with that $20,000? Where does it go? Yeah, we got it from the bank, but what's the business going to do with it? Well, the business, before they spend it, of course, the first thing they'll do with it is put it in their bank account. That's an asset. They own that. Got some value. So our $20,000 of cash that we borrow from the bank, it becomes an asset. It adds on to the $30,000 worth of assets we already have. So we've now got $50,000 worth of assets, but $20,000 of those assets is a liability. We've got to pay it back to the bank. The other $30,000 still comes from the owner because we got that from up here earlier. So our accounting equation still is an equality. $50,000 in total assets comes from, or is made up of, $20,000 in liabilities that we owe back to the bank in this case, and $30,000 in owner's equity. So you can see that every transaction that has an impact on assets, liabilities, and owner's equity must keep that accounting equation as an equality. It must keep it in balance. We're going to do a bunch of activities and exercises exploring the accounting equation. See you next time.